Hello, good morning, and welcome to today's webinar. I'm Pilar Thomas, a partner with Quarles & Brady, and I'm joined today by Joel Haspel, who's with Cogent Analysis Group. Our discussion today is focused on the American Rescue Plan and the amendments to the Small Business Credit Initiative. And we're going to talk about how tribes can begin planning for these programs, the $500 million pot of money. We're going to have a special focus on the venture capital program and the ability for tribes to use some of these funds, or all of these funds for that matter, for equity investments as venture capital fund. Again, I'm Pilar Thomas. I'm a partner in the firm's Energy, Environment, Natural Resources Practice Group, as well as in the Indian Law and Policy Group, where I focus primarily on tribal renewable energy development and finance, economic development, and natural resource development. In addition to the legal career that I've had, I previously worked for 15 years in financial services for a Fortune 250 company in all aspects of consumer mortgage and commercial lending. With me as well is Joel Haspel. Joel, if you could introduce yourself, please.
Sure. Hi, everyone. I'm Joel Haspel. I'm Vice President at Cogent Analysis Group. We are a boutique consulting company focused on primarily energy and economic development in Indian country. I'm looking forward to discussing the SSBCI program today with you, Pilar, and everybody on the line. Thanks for having me.
Thank you, Joel, for your time and presentation. So on the agenda, we're going to do a quick overview again of the State Small Business Credit Initiative. I'm going to focus on the program statutory parameters in the state small business statute. And then we're going to go into, and Joel's going to talk in a little bit more detail about tribes' opportunities in the venture capital program, a portion of some of the programs tribes can do. And then we're going to end with maybe some key questions for Treasury. And I also want to announce that we will have another follow-up webinar. This webinar is a follow-up to the one we had a couple of weeks ago. We're going to have another follow-up webinar scheduled for May 20th at the same time, 1 p.m. Central Time. So look for the information on that, where we're going to dig into a little bit more detail around loan guarantee programs and possibilities of working with Section 17s and native CDFIs. So with respect to the new amendments, I want to first make sure everybody knows that since we had the last webinar, there's been an update from Treasury on key dates for tribes. First of all, our notice of intent to apply will be emailed to tribal governments on or around May 10th. Those notice of intent forms will now be due on June 11th. Also around that same time, Treasury has indicated that they'll publish preliminary allocation amounts for each tribal government. Again, June 11th, about a month later, you'll have to file your notice of intent to apply. The form has not been identified yet, but Treasury has indicated that it will likely be that same simple one-page document that they had last time, a check the box form. And then by December 11th, applications will be due for both states, territories, and tribal governments. That application is also forthcoming. We haven't seen that application yet, but I'm going to talk through a little bit about what the old application looked like and some information that's going to be likely required for tribes in the new application. Please note that we still have not yet received scheduled tribal consultation from Treasury on this program. As an example, we had this in the last webinar. Here's an example of the previous notice of intent. This is literally the whole document. Obviously, there will be changes to it with dates, but the check the box, as you can see, you check whether you want to do a capital access program or the other credit support program, which is everything else, and then some contact information, authorized official, and signature. Treasury has noted on its website for the SSBCI, and they've, I think, made statements in previous tribal consultation that even if you file a notice of intent, you are not bound to apply. So if you decide after you file the notice of intent as a tribe that you don't want to participate in the program, then you don't have to apply, and there will be, as we say in basketball, no harm, no foul. A quick overview again of SSBCI. This was originally enacted in 2010 to strengthen state programs to support financing of small businesses. The law creates two types of credit support programs, the Capital Access Program and the Other Credit Support Program. Each program is a little bit different. The Capital Access Program has some limitations on it with respect to the size of the small business, no more than 500 employees, a $5 million loan cap, while the Other Credit Support Program has a slightly different target of 500 employees, but no more than 750, an average loan size of 5 million, but no more than 20 million in investment support. You have to apply to Treasury to administer the program. So just because you raise your hand and say you want money doesn't mean you're going to get it. You still have to apply to Treasury. You have to show that your program is in compliance with the law, and Treasury has to approve your program. And that will raise, that process, I think, will raise a lot of questions for tribes and for tribal enterprises. And we'll see some questions as we go through the VCP presentation of exactly what is it the Treasury needs from us as tribal governments, what kind of programs, what are the program parameters and design that are maybe slightly different than what's been done in the past. There is in the statute the ability to use at least 5% of the funds for administration. And this is the new website the Treasury has set up. And again, this has been updated from the last webinar. So let's take a look at the amendments. Again, tribes have been included in the definition of state. So now wherever it says state in the law, that includes tribes. $500 million allocated. Those allocations by the Secretary of Treasury, considering employment and economic data. Treasury has said, as I said earlier, that they will allocate the money to tribes by the middle of May. We're unclear how they're doing that without consultation from tribes, and what the employment and economic data, or what data they intend to use to determine those allocations. And so that's still a big question in the air. How much money is each tribe going to get, and how did they determine that? There are set-asides and incentive programs. There is set aside for socially and economically disadvantaged businesses. There's an incentive program for programs that show robust support for those businesses, and a set aside for quote unquote very small businesses, i.e. less than 10 employees. There are still, as we raised in the past, key questions. Are tribes required to design programs that meet some of these intentions, these set-asides? And if we do, are we eligible for the incentive program, as an example? So some questions remaining, and hopefully will get answered. Again, a quick summary of the programs. The Capital Access Program is its own separate statutory program. Everything else on this list, the other 4 programs, are all under Other Credit Support Programs, and they fall under a separate statutory requirement. I'm going to focus on the statutory requirement for the Other Credit Support Program, because that's where loan guarantee is. But before I get to that, I want to just maybe outline some things for tribes and enterprises and finance folks to think about as we go from here to December 11th. So a program evaluation, start today. What kind of programs do you want to design? What kind of businesses do you want to invest in? And start looking at, do I have the internal capacity to develop this? Or do I need to start bringing folks in from the outside? And that might be your Section 17 corporation who can help you pull this together. It might be your native CDFI. It might be a third party altogether. It might be your local bank, or it might be your financial advisor. But regardless of who outside might be, The tribe will have to have some amount of internal capacity, but it doesn't have to have a lot, and especially if you intend to outsource or have a third party administer the program. But the key question now is, what do I want to do? Of those 5 programs, which one or ones do I want to be involved in? What kind of businesses do I want to invest in? How do I start evaluating my program design? By just June 11th, if you've decided, yeah, this is probably something we want to do, or you don't know, raise your hand. File the notice of intent, because if you don't file it, you will not get any money. So even if you're not sure whether you want to get any money, still file, still ask for money. You have from June 11th to December 11th to make a final decision. So you may as well raise your hand, because again, if you don't, you won't get any money. And then start your program design, internal or hire out, and paying attention to the statutory requirements for each program, paying attention to the design options for each program, making a decision about the administration approach that you want to take. Do I want to administer it internally in the tribal government? Do I want to administer it through a Section 17 again, or a native CDFI, or do I want to hire outside completely? And then also you have to evaluate what your appropriate tribal legal actions are. The statute requires that you tell Treasury, we have the legal authority to do this. That may be something as simple as a resolution from council. It might have to be a full-blown adoption of certain laws or certain program parameters. Questions for Treasury. What does the appropriate legal action mean, in your view, from a tribal perspective? They make it very clear that for states, the state has to have the legal authority to do what it's doing. And that usually means some state law that allows the state government to do what it's doing. But we know tribes don't necessarily operate that way, don't necessarily have to have positive law, some ordinance that allows it. So part of the question is, what type of appropriate legal action is necessary for tribes? And that is, I think, a question for Treasury for consultation. And then we file our program application for program approval by December 11th. And I'm going to go through towards the end of this the types of information that's needed in that application. So from a statutory perspective, Section 12 USC, Section 570-703 lays out the statutory requirements for the secretary to approve a program. The secretary shall approve. It says a state, which now includes tribe, if there's a specific department, agency, or political subdivision designated to implement the program. All actions necessary to enable participation, that's the legal action that has to be taken. There's been, you've filed an application for approval, and you've executed an allocation agreement. There's also, this is the statutory authority that allows a state or tribe to participate if you have a contractual agreement with either another state or tribe, or an authorized agent or entities supervised, including nonprofits or for-profit entities. So this is the statutory authority that would give the tribe to, say, contract with their Section 17 to run the program for them, or to contract with ABC company to run the program for them, or to establish a nonprofit. Again, the native CDFIs are nonprofits, or to join together with another state and another tribe. So if you have 5 or 6 tribes who maybe want to join together and do a program, this is the statutory authority. And you have to tell Treasury, we're in a contractual arrangement with all these other tribes to run this program. With respect to the criteria, so this is found for the other capital support programs. It's slightly different for the CAP program. I'm going to focus on this one because, again, these are the 4 programs remaining: loan guarantee, cash collateral, loan participation, and the venture capital fund are all under this. So some of this stuff will be more applicable to a loan program, a loan guarantee program, than, say, to venture capital. but they all have to comply with this criteria. So at a minimum, you have to demonstrate a minimum of 1-to-1 leverage. For every dollar you get from the feds in this program, you have to put in another dollar. Doesn't have to be from the tribe. It could be from somebody else, but you got to put another dollar in. Now, there's an expectation. You have to demonstrate a reasonable expectation that if you do small business lending, it'll be a 10-to-1 leverage. So if I do a loan guarantee program and I put the Fed's dollar in, I got to go get another $9 or $10 in the loan amount, right? So that's my 10-to-1 as a very simple explanation. I don't have to meet the 10-to-1. I have to meet the 1-to-1, but I have to have a reasonable expectation. If I use lenders, they have to have their own capital resources at risk. Policy guidance says 20% minimum. So if I have a native CDFI and I want to do a loan guarantee program through the native CDFI, and again, the next webinar will go into more detail on loan guarantee programs. But let's, for purposes of a scenario, the native CDFI's got to put 20% of their own money in. You do the loan guarantee, and you got to do a 10-to-1. Average borrower size of 500 employees, no more than 750. Average loan size of 5 million or less, but no more than 20 million. So when you put start putting your programs together, you've got to design them around that. Additional statutory considerations. You have to show the benefits that are going to accrue to the tribe, your residents, and your businesses, including different types of expanded economic opportunities, generally jobs. The tribe also has to be able to show that it has the organizational skills, capacity, and experience that you can manage increases in volume of small business lending, that you have internal accounting and administrative control systems. You have to be able to show you can provide reasonable protection of that the funds are safeguarded, and you have to show your soundness of program design and an implementation plan. Now, if you're administering this directly, you have to be able to show this as a tribe. If you're hiring someone to administer it for you, they have to be able to show this. There will be some oversight the tribe has to be able to do, and you have to be able to ensure from your oversight that you can monitor your administrator, that they can actually do this. But when you check the box on the application that says we've contracted with somebody, they have to be able to show that they meet these considerations, these statutory requirements. Last set of statutory requirements, these are minimum program requirements. The secretary shall prescribe the program requirements. This is now found in the policy guidance, which we understand will be updated. But that's going to tell us some of the parameters, how they calculate leverage, how they evaluate your capacity, your experience, all that's in the policy guidance. The secretary can refer to the CAP program, which is in a separate section, but these are the kinds of things that you have to show in CAP: experience, investment authority, terms and conditions, how much capital is at risk. If you do some type of loan guarantee, what are my premium charges? How am I going to show the other contributions? And what's the purpose of the loan? So again, not all of this is applicable for all the OCP programs. There may not be, for example, premium charges or loan purpose if you're doing the venture capital program, because that's an equity investment. But you will still have to show what my investment authority is. And again, you have to point back to the benefits that are going to come into the program or come into the tribe. So as you're designing your program, part of, I think, the design should include who's going to administer this for us. And so as we said last time, you can directly administer it through the tribe, either individually or some other tribal type of intertribal consortium. But think of it as the tribal government proper administering the program, in which case you have to be able to meet all of those statutory requirements as an entity to be able to administer whatever program you design. Or you can create a separate governmental or nonprofit entity. For tribes that already have Section 17s that might have this capacity or this capability, that might be one way to do it. You might create a whole new entity that would do it. If you're big enough, you're going to get enough money, that might make some sense. Or of course, you can hire a third-party administrator, either a for-profit entity, another nonprofit entity, or a CDFI, and the CDFIs were common as third-party administrators in the last go-around. And remember, the 5% of the funds you get, that's the limitation now. There's a question for Treasury of whether we the tribes will be limited to that 5%, but can we be funded by the contribution of funds to the tribe? Okay, let me end my piece with an example of what was required on the last application form. And I have a site here. You can go to this website there and look at the old application form. Don't be fooled. It's 4 pages of the form, but there's lots of narrative that has to go with it. So obviously the legal entity, contact information, you have to indicate which type of program you're going to administer, whether it's the CAP program or the OCSP program, other collateral support program. And within the form, the current form, you have to check the box of what type of other credit support program you're going to do. So is it loan guarantee, cash collateral, loan participation, or venture capital? And in that form, if you go to this website and you look at the form, you'll see that if you get money, you can allocate it across the programs. You have to tell them how much money you're going to put in each program. And then for each program that you want to do, so let's say you decide you want to do 3 programs, a loan guarantee, a loan participation, and a venture capital. For each of those 3 programs, you have to include a statement about the program, the background, a summary of the guidelines. If you've done it in the past, some tribes have done some of these programs in the past, the historical performance of existing programs. And if you've never done it, the expected performance of the program. Can't be more than 3 pages though. So that's good. You also have to be able to show your private capital leverage ratios by year. So if you have a 10-year program for year 1 through 10, each year you have to show what you anticipate your private capital leverage ratios are going to be. You have to describe your results, what you think you're going to get out of it, with additional documentation for, again, each program. The anticipated benefits to the state, in this case, the tribe, its businesses, its residents, the extent to which you're going to have increased small lending opportunities. For loan guarantee programs, you have to make assumptions about the number of loans. If you're doing a collateral support program, you have to make assumptions about that loan value or loan amount, loan volume. Again, documentation not to exceed 5 pages. Metrics should include but not be limited to. The language in italics is exactly out of this application. It's exactly what the application says. So anticipating that the application will not be much different than it was before. This is part of our preparation for designing programs, and that is, I got to send this to Treasury to get approval before I get my money. So when I'm designing my program, I'm designing it to be able to fill in this application. How many jobs am I creating? The value of loans, increase in sales, income, or other tax revenue. Again, should include, but it's not limited to. So what other factors, what other metrics might Indian country be trying to achieve? What other benefits might we also be trying to achieve? And I think we would want to make sure that when we finally have our consultation with Treasury, if we ever get it, that we put some of these metrics on the table so that when we get to December 11th or before, whenever we file this, they know what's coming from us. We have to show our management experience, capacity, and how we're going to measure management performance. And then we have to show our auditing, compliance, and reporting oversight capacity. So kind of working backwards, if you're filing December 11th, and this is what you're filing to get your money, then working backwards, what are some of the things we need to learn, understand, develop as part of our program design that lets us answer this information, provide this information in our application form. And it may be that we think we want to do 3 programs, we start working this up, and we go, nah, maybe just 1. And so fortunately, we have from June 11th to December 11th to finally make our final decisions, but we've got to get it all ready to go so that when we submit it, it covers all the statutory requirements, it complies with the policy guidance, we've executed our allocation agreement, and we get Treasury to say yes. Now, one of the things we'll see when we talk about the VCP, and I think as we talk about later on loan guarantee programs, is what part of these programs are applicable to tribes versus states, and are there other aspects of these programs that make more sense for Indian country than make for states? And so how do we make sure that we get some type of confirmation from Treasury before we work up these programs? So if we design, Indian country, somebody in Indian country, a tribe or multiple tribes designs a whole new credit support program that isn't like any of the 5 that are listed, and says, this is what we need to accomplish these goals. How do we get Treasury to confirm and approve that program design before we submit the application? Because once we submit the application, if they say no, they've said no. Of course, we don't know what happens when they say no. Do we get a chance to appeal? But let's assume that, no is no. Then how else can we, and what else can we be doing as tribes, tribal enterprises, Indian country writ large, folks working with tribes to confirm with Treasury beforehand? Now, Treasury has said, I think in one of the consultations, and they've been having kind of these individual meetings with different people, but they've said, I've heard, well, we'll be working with folks, maybe we'll do some roundtables, maybe we'll do some of our own webinars, and that would certainly be helpful, at least in terms of us getting a better understanding of what do they need from us exactly, and what else can we be doing before we submit this application. Okay, before I move on, let me see what questions we have from the audience. Hold on, sorry. Okay, question number 1, when we get notified of our tribe's allocation, is that number the maximum we'll be able to access, or can we still apply for greater amount of financing? Okay, great question. So here's the key. So, Treasury says they're going to allocate before people raise their hand. So one question for Treasury is, if you pre-allocate to 574 federally recognized tribes and only 300 tribes raise their hand, because everybody else goes, you're not giving me any money, it's not worth it. So 300 tribes raise their hand. Do they reallocate? What do they do with the other tribes that said that they allocated to and didn't raise their hand? So question for Treasury, I think, is on June 12th, will you reallocate the monies for the tribes that didn't raise their hand? It begs the question, why are you allocating in the first place before I raise my hand? Why don't you just wait till everybody raises their hand and then allocate? But Treasury's, maybe they'll change their mind. But if they do allocate ahead of time, hopefully they will reallocate for those tribes that didn't raise their hand. And so hopefully they will get more money in that regard. Okay, next question. With the cap being $5 million per loan, is it implied that many tribes will be receiving more than $5 million for their programs? No. That's the statutory cap. It's not the average is $5 million per loan. The cap is $20 million for the OCP program. It does not mean we're going to get at least $5 million. That's just the statutory number. The state, remember, this was written for the states. the states will get a minimum of $56 million this time around. California, I think, is getting almost $900 million because it's a $10 billion deal. So tribes are splitting $500 million. I don't know how much we're going to get. I don't know how they're going to allocate it. They haven't said that there's going to be some minimum. So, that does not, it's not implied we're going to get more than 5 million. You might only get $1 million because of your population or employment, or however they decide to do it. This is just, if you get $1 million, you know, you're going to be well under the $5 million loan cap. Okay, how much of the program will be available to Native-owned businesses, not a tribal enterprise? That's going to depend on the tribe. So the tribes are the ones who are eligible for the money. As part of their program design, they will have to decide what they want to invest the money in. Do they want to invest it in their own tribal-owned businesses? Or do they want to invest it in tribal member-owned businesses or other Native American-owned businesses? That's for the tribes to decide. So it is a question, though, for Treasury. The states were allowed to make investments into state government corporations, which is akin, of course, to a tribally owned company. Tribal government corporation, if you think of it that way. But the key aspects of this program are to invest in small businesses, which implies, of course, tribal member-owned businesses. But in the end, it's going to be for the tribe to decide how they want to split their money. So if Tribe A gets $10 million and they decide we're going to put $5 million into programs that support tribal government-owned businesses, and we're going to put another $5 million into programs that support tribal member-owned businesses. That's what for them to decide, and they would have to put that into the application form. So if you're a member of a tribe and you want them to support tribal member-owned businesses, start lobbying. Okay, can the tribe use the funds as venture capital to invest it to make a return? I'm going to defer that question to Joel, who will be covering off how the venture capital programs have worked on the state side. And so save that question for Joel when he goes through his VCP. Okay, so speaking of which, let me go ahead and turn this over to Joel.
Great. Thanks, Pilar, and thanks everyone for those questions. So let's talk a little bit about venture capital programs. So what are state and now tribal venture capital programs? Well, basically, they provide investment capital to create and grow startup and early stage businesses. And these are words directly, again, from Treasury, just as Pilar did. I've pulled a bunch of language from their previous documents so we understand where they're coming from. And basically, a venture capital program typically comes in one of two forms: either a standalone fund that you, the state or tribe, own and operate independently of your, in and of yourself, and you make investments directly into portfolio companies or businesses that you put money into. The alternative to that is that your venture fund actually just makes an investment into another venture fund. You become, in effect, a limited partner in some third-party venture capital fund. And that fund, that sort of downstream fund, that fund goes out and does the job of sourcing deals and evaluating them and making investments into those individual businesses. And when you put your money into a fund that then invests in other funds, that's what's called a fund of funds approach. And that's a term of art that's used throughout all of these documents. And you'll see that a bunch as we go forward. Regardless, in most cases, day-to-day management is generally outsourced. Most states and tribes don't have professional venture capital fund managers on staff. It's complicated. There's lots of regulatory issues you have to deal with, not only from this program, but from the SEC and securities registrations and reporting and compliance and all of that. So typically, you outsource this sort of thing to a fund to a firm that knows how to deal with all of the details. Some other aspects of these programs, as Pilar said, typically venture capital investments are equity, which means stock, right? You're buying a percentage of a company that you're investing in. Sometimes there are hybrid investments where you have some form of debt that is part of the deal, but typically you're making an equity investment, buying a percentage of a company, and those funds are generally pretty much unrestricted. Once you invest them, they're there for any business purpose that the business management needs in order to hit its growth targets. State venture capital programs typically live about 12 years. An individual company investment typically lasts 3 to 7 years. During those 3 to 7 years, the company is either wildly successful and exits by way of an IPO in the stock market or acquisition by some big company. It stagnates, and the venture capital fund finds a way to get out, or it fails, and the venture capital fund loses its money. Any of those three outcomes is possible. The typical way that you construct a venture capital fund is looking for home runs, and if you make some outs along the way, that's okay, because the home runs are hundreds to thousands of times more lucrative than the individual singles or outs. And so you don't worry so much about those, and you're seeking in a traditional venture capital fund, you're seeking those home runs to get your returns. As Pilar also mentioned, 500 employee limit is your target, and the absolute cap is 750 employees. And again, average investment of 5 million, and absolutely no single investment exceeding 20 million, because these programs are intended to spread the wealth. So just to kind of dig in a little deeper on the model and why you do this, you do venture capital because you can achieve massive returns if you do it right and you have a good mix of skill and luck. Typically, the fund makes money by sometimes by dividends and revenue shares, but typically you're looking for big exits where you bring in huge returns from a couple of portfolio companies that create the targeted ROI for your investors. Typically, you're looking to try to get to at least a 2 to 4 times return on your investment, but really successful VCs can get to 20, 30 times or more of their money. And you're thinking of, companies that invested in PayPal and Apple and Microsoft and, big brand name companies that you've heard of. Most of them started off with $1 million investment from some venture capital fund at an early stage. And those guys turned around and made $100 million or $200 million on their investment 5 or 6 or 8 years later. So that's what we're trying to accomplish in venture capital typically. But those higher upside potentials have a cost. Obviously, you can't get something for nothing, right? So the risk that goes with that higher upside means that you have to get to scale. And I'm going to talk a bunch over the next several slides about the need to get to scale. Typical VC funds manage 50 million or more in assets. Some are 10 times that much or 20 times that much at the very outside, but most venture capital funds are in the 100 million to $200 million range of assets under management. And that's important because that means that they can invest a meaningful amount of money in a meaningful number of companies, so that they can spread risk and potential reward over a large portfolio, maybe dozens of potential companies in one fund's portfolio, and they can put in enough money to make a difference. A lot of companies, $100,000, $200,000, $300,000, it sounds like a lot of money, but it doesn't go very far when you're trying to build high growth, high reward entities. And so what you're looking for in venture capital traditionally is enough money to make big investments and to have enough in reserve that when the company inevitably needs more money, you're there to back them up and put in another 2 to 3 times what you initially put in. So you have to build these funds expecting that you need a large reserve, you need to have a long time horizon, and you have to have a big enough portfolio that you can spread your fees and costs and risk over that larger group of companies while still being able to put in enough money into any individual investment to really make a difference. So this can have a lot of implications for us here in Indian country, because to the point that somebody raised, does this imply, are we going to get a lot of money as individual tribes? Probably not. And so how does a tribe that only gets a relatively modest amount of money leverage that and achieve the scale that's required to really play in this space and get a piece of those kinds of huge returns? Well, we'll talk about that in a minute. To just sort of finish fleshing out the examples, this is a simplified diagram of what a single tribally managed VC fund would look like. Tribe gets $500,000, it leverages that with $500,000 of private money, and now we've got this little VC fund sitting here with $1 million. And what can it do? Well, it can make some investments. It's going to need to also reserve probably some of those dollars to pay administrative costs and do reporting and compliance. But for simplicity's sake here, it can make, you know, a handful of relatively modest investments, and it is probably not going to be in position to really put itself in the best possible place to get one of those giant returns, right? A handful of relatively small investments is like playing the lottery with, you know, not a lot of tickets. But if we go to the fund to funds approach, we can start to see how pooling resources as partners into a larger fund might start to get us to a place where we can play with the big boys. And so here you'll see that various tribes in this diagram with differing amounts of SSBCI money basically become limited partners or investors into this central VC fund. We leverage those tribal dollars with private dollars and we get a larger pool of money. And realistically, this is probably, you know, this 4 million example here is a minimum. That's the 1-to-1 leverage. Realistically, you're hoping to get more like 20 to 40 million out of this kind of scenario. And ideally, you'd get, you know, 10 or 20 tribes together, or 5 tribes that each got more money. And we could build a $50 to $100 million fund by leveraging SSBCI money with private dollars. At that point, you can make bigger investments in more companies, and it's a much higher likelihood that one of those portfolio companies hits it big and creates the kind of 100 times return that that you're really looking for. And out of that, then all those tribal owners get their piece of the action, and that 1 million in SSBCI funds turns into 20 million or 30 million or whatever the number is that comes back to your tribal account, and you can then reinvest that or go do other programs and projects with it. So again, the takeaway here is that pooling resources into a centrally managed fund is going to create opportunities for leverage, and it's going to create an opportunity to minimize the impact of overhead costs, because this one fund here is now providing compliance and reporting and overhead management for all those tribes, instead of each tribe trying to reinvent the wheel and do its own compliance and reporting from scratch. So that leads us now to questions to consider and recommendations for consultation with Treasury. And I'm going to turn it back over to Pilar to lead us through these last few slides.
Thank you, Joel. And let me point out, we've got a couple of questions on the investment. So let me pose these and get your thoughts, Joel. So first of all, the question, can the tribe use the funds as venture capital to invest to make a return? I think that answer was yes, right?
Absolutely. That is what these funds are primarily driving towards, is a financial return.
And I think if you look at some of the look back reporting that Treasury did when it looked at the best practices for venture capital funds, one of the key well, one of the shared metrics across all the venture capital fund models was a return on investment. So that seems to be a primary metric for venture capital funds, is to make a return. The next question, is the program really targeting startup or early stage companies with a 500 to 750 employee limit? That seems contradictory.
That's a great point. It specifically says small businesses, and they define that cap for us at 500 and 750. But elsewhere in their definitions, they use the phrase startup businesses. So I think that this is clearly not a pure traditional VC model. This is what we would call a double or triple bottom line VC model, where, you know, in a standard single bottom line model, people put money in, they want money out. That's it. Just dollar times, 100, give me back as much return as possible. A double or triple bottom line is looking at returns, but also job creation, or returns, but also social justice, or also environmental justice, or things like that. So there's a little more of a broad net being cast by these, because they're looking potentially at businesses that are somewhat more established. Maybe they're a little later stage, and so they're not true startups. They're not, two guys in a garage, or somebody with a napkin. But there are venture capital investments at all these stages as well. So, we typically think about VC as being the thing that comes in right at the very, very beginning. But in reality, there are VC investors everywhere from pre-seed stage through seed stage, Series A, Series B, mezzanine, and later. So part of what we're seeing with those numbers is the flexibility for a venture fund, tribal venture fund or state venture fund, to make maybe a Series B investment, where they might dive into a $100 million round that somebody is raising right before they go public. And we might only get, a tiny fraction of the company, but that's going to quickly convert into liquid, stock on one of the stock exchanges that we see growth and acquisition coming, and that's a good deal. There are lots of funds that are late stage funds, and they get small percentages, but the risk is much lower. And you could see a state or tribal venture fund, if there was enough scale, where you could diversify your portfolio and investment approach and do 20% late stage, and 80% early stage, or 20% late stage, 30% early stage, and 50% that you're going to do into project companies instead of product companies, where you're going to get a lower return, but the downside risk is also lower. So that's all to Pilar's point about starting to design what your risk tolerance is and what your desired outcomes are, so that as this, I would imagine, a small ecosystem of funds is going to pop up, where there will be a handful of these third-party venture capital funds that are going to be places for tribes to park their SSBCI money. And some of those will be, industry-specific funds. Some of them will be early stage only. Some of them will be late stage only. And so understanding what your thought process is and what your desired outcomes are is going to be an important part of making a decision about where to put those funds.
Okay, thank you, Joel. Another question: will accredited or QP rules apply to tribes using SSBCI money? Great question. Probably one for Treasury on whether I think. Well, I would defer to Treasury on that one. It's a great question. Are there existing tribal fund of funds that a tribe can now join? I don't know of any. I know that there are several tribes who have their own investment vehicles. I don't know if it's characterized as a fund of funds, but several tribes are in VC funds now, or private equity funds now. If anybody on the webinar knows the answer to that, or has a tribe or is working with a tribe that does that, let me know, and I can get back to the person who asked the question.
Yeah, and remember, just from a semantic standpoint, the fund of funds is your vehicle, the tribe's vehicle, that then invests in other funds. The question that we really need to start to drive at as Indian country is, where are the downstream funds that we can put our fund-to-fund dollars into, right? So you probably can't just call up, Menlo Park Ventures out in San Francisco and say, hey, I'd like to become a limited partner. I've got this, $500,000 of SSBCI money, let me in. They may or may not be interested in taking that on. So, and they may or may not comply with the requirements, because if Treasury wants those dollars coming back to Indian country, that's going to become a real challenge for existing funds that are out there in the commercial marketplace. So like I said, I would expect, and I've heard from some folks who are already thinking down this line, that there will be a handful of new Indian country focused venture capital funds that will appear over the next few months from people with experience in the industry and in Indian country, that will provide that landing place for fund-to-fund investments that will be compliant with all of the rules and regs here. And I think that's going to be the real challenge. That downstream fund is going to have to do all the things that Treasury says you have to do in order to use tribal SSBCI dollars. So we'll need to see who emerges on the playing field in the next several months, but I'm nearly certain that there will be at least a handful of those.
Question, will there be flexibility to invest in a private equity fund, or is this only limited to VC? Again, I think that's a question for Treasury. And that's kind of the slide we have here. How are they constructed and deployed? I think, there's no doubt that we're going to see a lot of again, Indian country unique aspects to venture capital investment as it's defined in this kind of universe. And so part of the key questions that we have for Treasury around design are questions like that. Is it just VC? Can we do a private equity investment? And do you care? Equity investment's equity investment. What difference does it make what vehicle it's in? That's like very similar. Can we make direct investments in our own businesses, for example? Or do we have to go through and create this venture capital vehicle that then turns around and invests in, say, our Section 17 or a subsidiary of our Section 17? That's why starting to think about these design questions and what will work for your tribe, your investment ideas, your investment risk, what your investment goals might be if you're thinking about using the money for equity investment. So starting to kind of gather these questions together, and we've posed just some based on just conversations and different conversations people are having about investing. What does it mean? Are we limited to tribal businesses? The question earlier, tribal companies, owned companies versus tribal member companies. Are we limited to just tribal businesses? Or will Treasury let us invest in anybody? Will we have a geographic limitation? Will we have to stay within our state boundaries like the states have to do? Or can we invest anywhere? What if I have a tribal member business that's not located in the state that the tribe is in? And they need investment and capital or a loan guarantee program. Can I help them no matter where they are? If there's a nexus that's required, what does that look like? And then this broader application.
Well, and that last question, Pilar, if I can interrupt, is really important, and one that I think it would be great to get some feedback. And we may run out of time here today, but maybe from, as a follow-up, is this question about, if your tribe has relatively limited economic development, but you see an opportunity in another tribe, in a business that's owned by another tribe or a tribal member, and this vehicle would provide a way to basically, to provide extra capital. So maybe another tribe has a business that needs capital, but their allocation of this money isn't big enough. But if we worked together, we could achieve scale that's required to fund that business to get to 100 times return on our money 5 years from now. To what extent do tribes want to focus only on businesses that are owned by their tribal government or their Section 17 or their tribal members versus some other Indian country business that happens not to be owned by their tribe but is owned by a member of another tribe, that would therefore be potentially eligible and could be a fantastic investment opportunity, might be the best investment opportunity on the board, just happens not to be with a nexus to your specific tribe. Do you want in on that best investment opportunity on the board, or do you want to go to that double or triple bottom line question and maybe pass up that opportunity because the other benefits are greater? And I don't think that we have any sense of the answer to that question yet. And I think that's an important one that tribes should be thinking about over the next month or two.
Okay, let's take a look at maybe some other questions. And again, if you have any information on native-owned, tribal or native-owned investment vehicles, let me know and I can get answers to some questions we have about that. Just as a reminder, these are some additional questions that were raised last time and that still, I think, are questions that we should consider posing to Treasury, or at least thinking about answering them around individual notice. Can I later join with a tribe in a joint program? I think the answer to that question is probably yes, based on what Treasury has said, but we would certainly, I think, want to confirm that. Can tribes designate their Section 17 to administer? That would meet the definition of, delegating it, I think, to a different department, agency, or political subdivision. Not all Section 17s are political subdivisions, but we generally think of them as subdivisions. What data are they using to allocate funds? What ROI measures will VC programs be judged by? This, again, a design question. Can we invest or provide support to tribal-owned companies? I think that answer is yes, but again, we want to clarify with Treasury. Are we eligible for the billion? Do we have to comply with these target goals and requirements for very small businesses and socially and economically disadvantaged business targets? That's in the application. Today is, what are you doing for socially and economically disadvantaged businesses? That's always been a target. Do we have to also comply with that? And then how do we pay for everything? So we certainly want maximum flexibility as we're designing and thinking about this. It seems that part of the answer to our question of, how broad can this be, is it should be as broad as possible. But obviously every tribe is going to be different. But certainly the broader that we can get Treasury to go, the more we can use this money for, maybe the more benefit we bring to the tribe, whether it's revenue and income, or whether it's jobs, or a combination of the two. But the primary goal, of course, of venture capital is you want to try and find not just high growth companies, but companies that are going to be successful. And so the idea isn't just to grant money to people and hope they make it. The idea is to invest and hope that that business stays sustainable, especially if it's creating jobs for tribal members or on tribal lands. How do we maximize our opportunities to achieve scale? And it would be very helpful for us to get guidance from Treasury about how we can invest our dollars and whether we can use other funds, or how can we use other funds to leverage. So we're getting billions of dollars through the ARP, through the $20 billion pot, through the $100 million capital project pot. We're going to get another $500 million starting in October around consistency. Can we leverage all of those dollars together with some of these? They may not count as the one-to-one, but hopefully we could get some understanding that we can actually put some of these monies all together so that we get better economies of scale, especially if I'm a tribe that doesn't get much money through this program, but I get a bunch of money through other programs. Can I try and put them all together? And then maybe the last piece is around the administrative burden. So I showed you all the statutory requirements we have to have. Smaller tribes that get smaller amounts of money, the administrative burden might just be too much, and the amount of money that you get might not just be worth it. But if we can find a way to propose to Treasury that even if I get a small pot of money, if I can find a way to match it up with somebody else, minimize my burden for oversight, if I've got a third party, or I throw it into the pot, right, with the other 5 tribes into a fund, how do I ensure that we obviously have to meet the statutory requirements for reporting and compliance, but there should be some consideration that 574 tribes splitting $500 million doesn't, and depending on how they do it, is not going to be a lot of money for a lot of tribes. So if we really want this money to be spread out as much as possible, and Treasury has said, we want to see 574 notices of intent, to which I think somebody said, well, then you better give everybody a lot of money. So I'm not sure how that's going to happen, but we certainly don't, I mean, they probably don't want to be quoted on that. But let's assume we want to try and spread this out as much as possible. This administrative burden is going to be a huge barrier for tribes, especially smaller tribes who don't necessarily have the internal capacity to be able to put their money that they get to use. Okay, so with that, here's our contact information. Again, as a reminder, number 1 recommendation, start planning now, start designing now with an eye towards the statutory requirements, but just as importantly, with an eye towards Treasury consultation. There are a lot of folks talking about ways to use this money that's unique to Indian country. There have been some suggestions about kind of people pooling their money for certain types of investments, like investing in ag producers, maybe investing in energy, maybe investing in, doing a fund that invests in tribal construction companies. And so there's a whole host of varieties of ideas that I'm already aware of. I know everybody on this call and the webinar have been talking about it. So as we think about these designs and as we look at and compare them to our statutory requirements and our policy guidance, where we start to deviate is where we, I think, need to get confirmation from Treasury that we can deviate, that it's okay that we have this metric or this design. Just because the states didn't do it doesn't mean we can't do it. And so I think those are going to be huge opportunities for us to work with Treasury, hopefully get some guidance before we start putting our shoulder to the grindstone on designing these programs. The last thing we would want is to spend a whole bunch of time and maybe even a whole bunch of money designing programs, and on December 11th we submit our application and Treasury goes, yeah, no, doesn't work. So some things to think about. Again, I know we're a little bit over. I apologize. If you have any further questions, please feel free to email me or Joel. Here's our contact information. The presentation is available in the handouts. Also happy to forward the presentation. This is recorded. You'll be able to, we'll forward you the link to the recording if you want to share it with any of your colleagues or tribal leadership. And lastly, let's hope we get consultation from Treasury soon so that we can get some of these very important program design questions asked and answered. With that, thank you very much for your time. So have a good rest of your week. Thank you, Joel.
Thanks, everyone.